Welcome to our lecture, and we have some great things in store for today. We have a discussion about inventory, which can be found in our readings in chapter 6. And inventory is a great topic, let me tell you why it's relevant. Most likely, whatever you do for a living, the chances are you'll be involved with inventory, whether it be from a managerial aspect, maybe staff, supervision, possibly in the accounting department, even doing some of the things that we talk about today with accounting for the inventory. And it has a big effect on how much the firm makes, because the way that they present their inventory, the way that they actually choose to cost their inventory out, has a big effect on the bottom line. As we'll see today with some of the things that we'll go over, there's a couple of choices that you can choose for evaluation methods, and we will see those in this week's material. So let's get started. I'll put you guys on screen share. Bring up my screen. All right. I also have a good video for you too from a really great guy. He gives some excellent lectures, and so we'll get to that in a few moments too. All right, inventory and cost of sales. So let's talk about determining inventory items. First of all, we have to have merchandise inventory, and that are the goods that the company holds for sale. Remember, the merchandiser actually purchases the items completely ready for sale and then just sells them to the public, let's say Macy's or Target. So remember the difference between the merchandiser and then, of course, the manufacturer. So we need to pay special attention to goods in transit. They're accounted for a specific way. Goods on consignment, those are items that are only considered owned by the firm upon sale. And then goods damaged are obsolete. And damaged, we absolutely can picture. Obsolete can be something, a good example of obsolete is if we find that we have a pair of shoes and we only have, the next box we open, we only have one shoe, not a pair of shoes. Somehow the other shoe disappeared. We're never easily going to sell one shoe. So that would be something that's obsolete. And then things that just become obsolete because they're just too dated and time-wise they're not in fashion, or they're just obsolete because of being replaced by newer and more modern items. And so sometimes we'd have to write those off the books too. So here's a good visual of what's going on, goods in transit. We see that we have the seller. We have, in this example, somebody transporting the public carrier and bringing the goods to the buyer. We also have the seller and then free on board destination point, which is a term that we become familiar with this week, and then to the buyer. Items on consignment, like we mentioned before. You can actually put your goods up for sale in a consignment shop and let them show it because they have a place to show the items, and then if they sell it, they will give you the proceeds. So in other words, you see the gentleman there saying, thanks for selling my inventory in your store. That's the best example. We see that the damaged and obsolete goods should not be counted in inventory if they're not sellable, because they're just sitting there. They might as well have been thrown out, given away, whatever. They have no value to us. They're never going to be sold. And so, unfortunately, we need to take a hit and write those off. Get rid of them. Don't include them in inventory. And then we then adjust the inventory at that point. And it's something that we might hesitate to do. Be careful of that. You might see that managers are hesitant to accept that because then it's an expense to them, to what their numbers look like for the period. But it's not a true picture if we include them. You'll always hear them say, I think I'll sell that set of spark plugs from 1972 and just waiting for the right customer. Well, if they can convince you, then that's fine. But you have to use a reasonable approach. So determining inventory costs. And we see that when we determine this, we have to include all expenditures necessary to bring the item to sellable condition and location. So when we see condition and location, we realize that there might be some transport in there too. When it comes to internal controls, we'll see that the firm has to have a very good handle on inventory and that they're going to take a physical count if they have inventory. You know, not every company has inventory, right? And keep in mind, you might work for a service industry right now that doesn't have any inventory to count, or at least very, very little. So it depends on where you work. But if you do have a firm with inventory, you're going to take that physical count. It's probably going to be at least once a year. And then you go in when you are done and match it to the books, to what it says that you thought you had an inventory, to what the count comes up to, and then adjust the books to the amount of the physical count. And why would that be? Why are you adjusting to that? Well, the physical count is going to be the new ending inventory number because you just took the count. We know that's what there is if the count was done properly. And that's our new base point for the next period. So maybe we had some shrinkage and we see some internal controls mentioned below. Good internal controls include pre-numbered inventory tickets. If the counters have no inventory responsibility, because we don't want to take the chance that they will purposely miscount, right? If you can count, confirm existence, amount, and quality of inventory. Second count is taken, and manager confirms all items counted. And there's actually some good fraud cases out there where inventory was played with that maybe we'll get to later, which are really some interesting ones. So we see that we have a couple of costing systems. The first one here is the perpetual system. And the perpetual system, you'll see where inventory affects both financial statements, the balance sheet and the income statement. And the matching principle requires that we match costs with sales. So management's decisions in accounting for inventory involve items included in inventory and how much they cost. They're going to pick a costing method, whether it be FIFO, LIFO, weighted average, specific identification. They're also going to pick an inventory system, whether it's going to be a perpetual system or a periodic system. And then the use of market values or another form of estimates. So here's a couple of choices for cost flows. We can have FIFO, first in, first out. And it's probably the most logical because it assumes that the costs flow in the order incurred. So whatever you took in first is the one it assumes that you took out of inventory. Last in, first out, it's the reverse order. So when we sell something, we're going to take out the last one that we put in. In theory, you might look at that as being a little bit unusual, especially if you're talking about something, let's say milk, rotating on the shelves, that you certainly don't want, or there'd be no logic to taking out the newest milk that you just got in, if you were the supermarket, because hopefully you sold milk that you had longer, right? Because when would you ever sell that old milk if you keep taking out the newest milk that was received? So it's an awkward way to look at things if you look at the physical products, but there's some very effective reasons why you may want to keep your books according to LIFO, and you can. And then weighted average assumes the cost flow at the average of the costs available, which makes sense. That one absolutely makes sense too. So here's FIFO, the first in, first out. Get rid of the oldest, and then adjust ending inventory. Last in, first out, take the recent cost to cost of goods sold, and the oldest cost to ending inventory. Weighted average, we just take this formula, cost of goods sold available for sale, divided by the units at hand on the date of the sale. And look what a difference it makes. Let's look, and that's really where it really comes into play, what we're doing and why these choices are so important. The reason they're so important is because it affects the bottom line. And we see the income statement. Look here, or depending on which costing method we use, look how different cost of goods sold came out. That's why I say there can be some companies that use LIFO, and it might be to their benefit, and that's why they chose it. But in this case, LIFO had a pretty high cost of goods sold, which affects the bottom line, as we're going to see. So look how they ended up with the lowest net income. A lot of times the firm is looking to maximize the bottom line at this very point in time. So here we are at FIFO, and look at the inventory. Look how it differs too. Ending inventory balance on the balance sheet. So it's affecting the income statement and the balance sheet. Here's some advantages to each. In weighted average, we see that as we're taking an average, it can smooth out the price changes because we're always doing that average. So the highs and the lows don't have a major impact all at once. In, first out, the ending inventory then mirrors the approximate replacement cost. And then last in, first out, better matches current costs in cost of goods sold with revenues. And it's true, it will do that. So that's one advantage. We see that IRS has an impact on this, and we want to make sure that the method that we choose is acceptable to Internal Revenue for tax purposes. And if not, then we'll have to report on an acceptable method basis. So we might use two sets of books where one is for taxes and one is for management. If we do that, that's fine, but remember to use one that's acceptable to IRS when you file. And we see here, if LIFO is used for tax purposes, IRS says it must be used in financial statements. We have to be consistent, and the consistency principle reminds us of that we need to use the same system from year to year so that people can look at our company adequately. If they look at us switching costing methods every year, then they're never going to know how we're really doing, because we're changing the way that we keep the books. And doing that would have to be noted very succinctly. Lower of cost or market is a good concept mentioned this week too. And there are times when inventory has to be reported at market value. And let's look at the handout. Defined as current replacement cost, not sales price, and consistent with the conservatism principle. Can be applied in three ways: separately to each unit, or to the major categories of assets, or to the whole inventory. Now, this topic is on errors, and we know that our inventory, we said, affects both the balance sheet and the income statement. And here's income statement effects. So if we have an error, look what happens to cost of goods sold and net income. If we understate the ending inventory, then our cost of goods sold will be overstated and our net income will be understated. If we understate beginning inventory, we see that our cost of goods sold will be understated and our net income is overstated. So inventory errors are a problem, right? You're causing problems in a couple of statements here. If you overstate the ending inventory, then you're going to understate cost of goods sold, which is going to overstate net income. And if you overstate beginning inventory, you're going to overstate cost of goods sold and understate net income. So that's the effect these errors can have. All right, let me get on to what I have for you, a video I have for you that I'm going to pull up. And see. Okay, here we are. This is Larry Walther, and he's going to go over some of the things we've been talking about. It's just a short video. I recommend and subscribe to his videos, and I have a bunch of his videos on my website, deborahtuohy.com, and he puts things very well. There's a couple of good lecturers out there that I can recommend, but hearing these things in accounting, repetition is key. So let's hear how he puts things.
Principlesofaccounting.com, Chapter 8 on inventory. In this particular module, we will look at the basic concepts of inventory costing, FIFO, LIFO, weighted average methods. This is a very important module. Let's start with the basics, however. The aggregation of the beginning inventory and purchases gives us the goods available for sale. Our challenge is then to take that total amount assigned to goods available for sale and decide how much is included in ending inventory for the balance sheet and how much should be reported as cost of goods sold on the income statement. It's really an allocation problem. The cost of goods available for sale must be allocated either to cost of goods sold or to ending inventory. Cost of goods sold appearing on the income statement, sales minus cost of goods sold, giving you gross profit, or ending inventory appearing on the balance sheet. Before we look at the specific methods like FIFO and LIFO, though, consider this. If I allocate $1 more to cost of goods sold through my costing methods and $1 less to ending inventory, that's a necessary thing that occurs. If what's available to allocate, if I place $1 more here, I necessarily place $1 less there. And by placing $1 more in cost of goods sold, that causes gross profit to be less. Sales minus an increased cost of goods sold would give me less gross profit, and $1 less in ending inventory would give me less on the balance sheet for the asset inventory. So inventory is pushed down, profits are pushed down, retained earnings is pushed down, the balance sheet equality is maintained because inventory is going down as are profits if I were to shift that $1 from one category to the other. Now, as we think about what costs to include in ending inventory, it's important to remember that inventory should include all costs that are ordinary and necessary to put the goods in place and in condition for resale. This would include the invoice price, the freight cost, that is freight in, the cost that's necessary to bring it to its intended condition for resale, and similar items. It does not include, however, carrying cost of inventory, such as interest that's incurred on financing inventory, storage, or insurance costs. Those costs are expenses incurred. They are not inventoriable type costs. Also excluded are selling costs, freight out cost, which is deemed to be a selling cost, salesman's commissions, and so on. Those costs are also expensed as incurred. Now, costing methods. Each unit of inventory will not always have the same cost. As we buy or acquire or manufacture goods, there may be a different cost that's incurred per unit. Therefore, a company must adopt an inventory costing method that is applied consistently from year to year to allocate the cost of all of the units to the units that are in ending inventory and the units that are actually sold or cost of goods sold. So this gives rise to certain cost flow assumptions, which are assumptions about how costs are assigned to inventory. It bears no relation to physical flow of goods. If we're talking about milk, for example, we could cost that milk inventory by FIFO or LIFO or an average cost method. Even though selling that milk, we would probably try to sell it on a first in, first out basis to get rid of the older stock and constantly keep the newer stock, hold it back until we clear the older stock out of inventory. But no matter how our physical flow is occurring, such as I've described for milk, we can use any of these methods to assign the cost flow for accounting purposes. Looking at first in, first out, or FIFO, the oldest cost, the first in, are matched against revenue and assigned to cost of goods sold first. The recent purchases, those that are left over, the most recent cost is assigned to ending inventory. Looking at an example, we had zero beginning inventory. These are nails, barrels of nails, and we had 3 purchases during the period. We bought 100 pounds of nails at $1, 100 pounds at $1.10, and 100 pounds at $1.20. The total cost of all of our purchases was $330. Our goods available for sale was $330. When we allocated this on a first in, first out basis, we sold 160 pounds in this particular case. What sold first was this red barrel at $1 and 60 pounds out of the green barrel at $1.10. That's our 160 pounds that were sold from the first units purchased, the red and the green, and we came up with cost of goods sold of $166. The other amounts, the 40 pounds that remained from the green barrel and the 100 pounds from the blue barrel, even though the units are all commingled, those amounts we're assigning to ending inventory. Conversely, last in, first out is just the opposite. The recent costs are matched against revenue and assigned to cost of goods sold, while the oldest purchases remain in inventory. So here we have the same purchases of barrels of nails, 3 barrels at 100 pounds each, at a different cost per pound. When we assign our $330 of cost of goods available for sale, here we're taking the blue and the green first, that is the last in is the first out, and we're assigning that to cost of goods sold. It's $186. The ending inventory is from the earliest purchases during the period. Last in, first out. Last in, first out is uniquely a United States-based accounting method. Many parts of the world will not recognize or allow the LIFO method. Finally, the weighted average method is a blending of these two approaches. An average unit cost is used to calculate the cost of goods sold and ending inventory. It's very simply determined by dividing total cost of goods available for sale by total units. So in our nail example, $330 was spent on 300 pounds of nails. giving us an average cost of $1.10 per pound. And with 160 pounds sold at $1.10, we had $176 in cost of goods sold, and our ending inventory, 140 pounds times the same $1.10 average cost, gave us $154 assigned to ending inventory. You might find it helpful. Indeed, I would encourage you to look at the textbook. This very illustration is used in the textbook and explained there again, and it probably would be helpful to actually sit down and really think about the mathematics of what's happening with FIFO, LIFO, and weighted average. To recap, first, remember that beginning inventory and purchases gives us cost of goods available for sale, and that amount of cost must be allocated either to ending inventory or cost of goods sold. Second, accountants adopt a cost flow assumption to track those inventory costs within the accounting system, whether that's FIFO, LIFO, or average cost. Third, the adopted cost flow assumption need not bear any relation to the actual physical flow of goods. The costing method is independent of the physical flow of goods. To recap briefly then, with first in, first out, we have our beginning inventory in gold and our purchases in blue here. Together, that comprises our goods available for sale. Under first in, first out, our cost of goods sold includes those gold units from beginning inventory as well as some of the purchases. What's in ending inventory was from the very last purchases during the period. LIFO is just the opposite. Here we have the same beginning inventory and purchases rolled together to give us goods available for sale. The ending inventory is all gold. It came from the beginning inventory in this case, and indeed a little bit of the beginning inventory is deemed to be liquidated along with all the purchases in the period. And the weighted average, what I try to show here is all of the cost gets blended together for an average cost, and that cost is interspersed in both ending inventory as well as our cost of goods sold. In the next module, we will look at actual mathematical examples of applying FIFO, LIFO, and average methods.
All right, let me pause that. And it's funny, he used the milk example. I didn't even remember that he did, but it's the kind that, it's one of those examples that's usually used in our textbooks, and so it was kind of amusing that he used that one too. All right, I had a couple other things. I went through the inventory errors. Let's see. A good ratio, we'll throw in this always, great ratios to go along with everything that we do. Inventory turnover. We want to see how much the firm is turning over their inventory, because that shows that they're doing their jobs well, right? Just from the sound of it, how often are you turning over your inventory? And it helps us see, we can compare again with ratios to our competitors. We can see if we're turning over our inventory as fast as the firms that we compete against. We can also compare to how we did last period or last year. The calculation is simple. It's just cost of goods sold divided by average inventory. I get asked a lot of times how we come up with average inventory, and that's circled below. It always seems like it would be something more complicated to students, and it to me too, but it's just taking the average as the beginning inventory plus the ending inventory divided by 2. So it's a very simple average. Another good ratio, day sales and inventory. We want to see how much inventory is available, and we take the ending inventory divided by cost of goods sold times 365 days, which is the approximate number of days in a year. We'll always use 365, even if it's leap year or something different, you just consistently use 365. The global view, interesting to look at too, because we saw that if we go with the convergence project at some point when it's completely integrated, there will be some changes to what costing methods that we'll be allowed to do, because IFRS, the international method, does not allow certain costing methods, as we learned earlier. All right, so that concludes what I have for you guys. Take you off sharing. Remember, I'm always available for questions. Just drop me a line and I will get back to you, and enjoy your week. Thank you for listening.